You're now listening to the Tax Smart REI podcast, the number one tax podcast for real estate investors. Hey, thanks for tuning into this week's episode of the Tax Smart REI podcast. Today, we're going to be going through frequently asked questions about the short-term rental loophole, questions that we get all the time from Tax Smart insiders and clients at large. We're going to answer questions such as, can you use the STR loophole if you take a second home loan from the bank? Can you use the STR loophole with partners? What the biggest mistakes are that people make, and a lot more. All right, so I'm going to be diving into all of that in just 1 minute. Hey, are you an investor looking to slash your tax bill? Then get ready to discover everything you need to know about the short-term rental loophole to save up to 5 to 6 figures in taxes with our comprehensive STR Tax Course. Valued at $247 is now just $1 for a limited time when you sign up for our Tax Smart Insiders community. Here's what you'll get when you sign up. Learn tested methods that have helped thousands of investors maximize their tax savings, get expert guidance and support from our team of real estate CPAs, and enjoy unlimited access to the course materials. Don't miss out on this incredible limited time offer. Visit www.taxsmartinvestors.com/free STR course to enroll today. Again, that's www.taxsmartinvestors.com/free STR course to enroll today. We'll see you there, but for now, we'll dive right into today's episode. All right, and we're back. So we're going to be going through short-term rental, frequently asked questions from clients and the community at large. With all of these audits going on, everything that's going on right now with short-term rentals, people are still using this strategy, still a great strategy if you are into running a short-term rental business. So I'm going to start with the first question, and the first question is, can I use the STR loophole if I use a second home loan from the bank? And to give some context on this, sometimes you might go buy a short-term rental property and your bank might offer you a second home loan or a vacation home loan. And that's usually typically used, or the way the bank views it, for a second home or your vacation home, not necessarily as a rental property that you're going to rent out. And by sometimes using that and then going ahead and renting out your property, you might run into some issues with the bank if they find out, right? And whether or not that happens, that's between you and the bank. However, from a tax perspective, there's no issue if you use a second home loan to purchase your STR, because for tax purposes, you use that property for business. You're going to be able to deduct that interest, the mortgage interest, but never the principal, on Schedule E of your tax return in most cases for short-term rentals. Ryan, is there anything you wanted to add to that?
Yeah. What we've commonly seen is that your bank for a second home, vacation home, is going to essentially require you to have some personal stays at your home, at this new home that you're acquiring. And so a common question we get is, okay, well, and we're going to get into personally using the property here in a little bit, but kind of the dilemma of, okay, they say I have to stay here for 14 days this year or every year, kind of depending on the bank's requirements, but I don't want to use the property personally because, again, in a bit, we're going to talk about how that's detrimental for personal use of a short-term rental in a moment. So I just want to highlight, just for the sake of this part, to say that how the bank views a personal stay at your place versus how the IRS is going to define a personal use day with a short-term rental, very different things. And I'll just say now, to kind of preface it, you can satisfy both definitions, still stay there personally, satisfy the bank of 14 days, and you can have 0 personal use days as far as making sure you get all the deductions you can from your short-term rental. So you might have that, as a question. That is something we hear a lot. We'll get into in a little bit how you can satisfy both. But at the end of the day, the last comment is, it's in my mind, I can't think of a lot of situations where how it's financed is a big deal, right? What type of loan or whatever it is. It's very infrequent. So that comes up a lot where the client's like, hey, I've got this type of loan. Does that matter? Does that impact it? Does that mean it can't be a rental property or a business, whatever? Generally, no. So those are just the 2 comments I wanted to throw in there as well.
Awesome.
Another thing that we should discuss, if you co-own a short-term rental with a partner, let's just say, for our example, 50-50, can you still deduct a taxable loss against your W-2 income, right? Short-term rental strategy, really beneficial for high-income W-2 earners or full-time business owners to basically take a short-term rental once you meet the loophole requirements to then offset it against your W-2 active income. So what if you've got partners, right? That makes it more complex because of the material participation test. The first step of the short-term rental strategy, 7 days less or whatever, that doesn't impact the whole partner situation, okay? But the part that does become more complex is material participation. And we'll just talk about 2 and why this is complex. So let's say Tom and I go buy a short-term rental, we're 50-50. Let's pretend that Tom is really the one who's managing this property, talking to contractors. Maybe he shows up to the property a few weekends over the course of the year, and Tom is going to put in 400 hours. Let's say I own the other 50%, and I only put in, say, 100 hours, right? Maybe I'm helping a little bit with some improvements, a little bit of management, but I'm really like not that involved. So as we think about Tom and I are two completely different taxpayers, right? As we look at material participation, we're going to have to evaluate really two main tests. Number one, the 100 hours and more than anyone else test, or two, the 500-hour test. Okay. So in my example, neither of us hit the 500-hour test. So we're really using the first one. So between the two of us, right, the last aspect of that first test, you accumulate a minimum of 100 hours and your time is more than anyone else. Well, heck, although I own 50%, I didn't get more time than Tom. So I can't use material participation or the short-term rental strategy. Tom could, assuming he's got the most, right? But the only way to get around that, so that's the dilemma, right? Only Tom can use it. I can't because I don't have more time than Tom. The only way to get around that is that both Tom and I, as partners, both meet the 500-hour test. Depending on the property, the size, and whatnot, that could just be really difficult to do. And so people just need to be aware there's a unique complexity that goes into partnerships. 50-50, it doesn't matter, 90-10, 50-50, whatever. But if you're trying to meet this and offset that W-2, you've got to evaluate material participation and evaluate, is one of you getting more than the other? Great. That person's probably going to use it. The other partner might not. The only way around that is the 500-hour test.
Yeah, yeah. And in my experience, it's on most short-term rentals that I've came across with clients and insiders and what have you, the properties just aren't large enough and there's just not enough work to go around. So usually what happens is one partner qualifies. And, unless you're going to do like a hotel or something like that, where you're going to have, significant amount of efforts by all parties, it could be really challenging to do. And we frankly just don't see it that often. And one more thing I wanted to add on to this. Now, it's different if you're a husband and wife, okay? Remember, as husband and wife, material participation, when you're married, it's as if you're one individual. So if your spouse spends 100 hours and you spend 0, you're good. If your spouse spends 75 hours, let's say, and you spend 50 and you get to 125 and no one else spent more time than you outside of you and your wife combined as one person, then you're in the clear. So that's one thing I wanted to note there. One more thing on partners that I get a lot of questions on is, and we're going to talk about the 14-day rule in just a minute. And that's what happens if now you and your partner, you both have this property, you may want to stay there for a vacation, right? Well, for the 14-day rule, which I'm sure longtime listeners are being aware of, but again, we'll get into it. It's your days are combined too as partners. So if one partner spends 8 days there, that means the other partner can only spend 6 days there. I've been doing my math right. Okay. So just remember that. And that could be problematic when you have 3 or 4 partners, right? And that goes for your partner's family members as well. So if your partner has their mom or their child or whatever stay there, that also goes against the personal use time. So it's just something to keep in mind. The short-term rental loophole can be challenging when you're dealing with partners. That's kind of the bottom line there. All right, so we're going to move right on to the next one. And this one is the 14-day. How long can you use your STR personally and still use the STR loophole? So the regulations under Section 280A say that if you use the property for more than 14 days or 10% of days rented, so for 15 days or more, in many cases, people just simplify it, 15 days or more, then it's going to be considered a residence. And when it's considered a residence, you still have to report your income. You still have to report your expenses on Schedule E of your tax return. However, long story short, your expenses are capped at the income that it generates, and you cannot deduct the losses against your W-2 or other income when it is a residence. So if you want to use the STR loophole, it's important that you keep it under 14 days or 10% of the days rented. For most people, it's going to be 14 days. Just think of in your mind, you could use the property for up to 14 days and you're good. Use it for more than 14 days, now it's a residence. And your losses are limited and you're not going to be able to use it against your W-2 or business income, which is the purpose of the STR loophole to begin with.
The only other thing to add into there too, and we might talk about it a little bit later as well, but the other thing too is, what if I even just use it for 7 days, right? If we use it for 7 days, we've stayed below the 14 days, 10% rule. That's good. But the common thing that people forget is that we still have to evaluate what was the number of days used personally for the short-term rental, and then what was the number of days used as a rental. And so now what we're coming to is this percentage. Let's pretend that it comes to 95% rental and 5% personal. What we have to then do is take some of your expenses and only be able to deduct no longer 100%. Now we can only deduct 95% of those costs because the other 5% was used personally, right? So that's another nuance here. If you use it more than 14%, 10%, like Tom said, can't take losses. But even if you use it less, you're taking less deductions, and we have to be careful of that. So anytime someone asks me, oh, yeah, we didn't use it more than 14 days or 10%, I'm good. My actual response is usually, well, how many days did you actually use it? Because even one personal use day can have a negative tax impact. It might be small, depending on the expenses and whatnot, but it can have an impact. And I just want to remind our listeners about that too.
Absolutely. And there's two more things I wanted to throw in here as we were kind of talking that came to mind. And that's the myth that if you don't rent the property for more than 14 days, then you can't use the STR loophole. People have came to us before and said, oh, my CPA said that if I don't use the property for more than 14 days, then I can't use the STR loophole. And that myth comes from, say you have a residence, a property that you live in, like a vacation home. In other words, you use for more than 14 days personally, right? So it's your residence. And if you rent that property out for 14 days or less, then you don't have to report that income on your tax return. However, if you have a pure business property, right, and a short-term rental, you don't use it personally. In other words, it's not a residence, right? Then you can rent it out for 7 days. And that might not be recommended to rent it out for only 7 days, but it's still a business property and you could still theoretically use this according to the regulations and the tax code and all that. So it's something else I wanted to throw in there.
One other thing too, with the 14 days that Tom just talked about for people listening, that's kind of the Augusta rule, is what a lot of people have heard it referred to as. So it's kind of the idea you rent your primary residence for 14 days or less. You then don't have to report that income. The key thing there is it is your primary residence. Okay. So if you've got just something that's a short-term rental, you've got the second home, whatever, and it's actually considered a business and it's not your primary, right? That's the key thing. It's your primary residence. You're using it for 14 days or less. Don't have to do that. That's the Augusta rule. What we're talking about is something different. So just keep that in mind as far as kind of what we're talking about here and just putting names to things that we're discussing. But moving on from there, we're going to do another section here of kind of some other common STR loophole mistakes. So moving right along into that. So one of them is using a property personally for more than that 14 days, 10%. Obviously, we just kind of discussed that. But one thing we just want to tie in as well is that people also forget that that is going to include not just partners that we just talked about or yourself, but also other relatives. So essentially, like relatives, family would include essentially lineal descendants. So that would be like children, that would be parents, that would be siblings. But even though we're kind of talking about who's kind of like personal, right? We also just want to be careful of simply allowing someone to stay there for free, right? So maybe you've got a friend or a cousin who maybe doesn't meet that lineal descendant type thing. But if you allow someone to stay there for free or well below fair market value, the IRS is going to also see that as a personal use day. So we just have to be careful. If we're trying to keep it simple and just abide by the rules, don't get cute around giving it to friends and family for free or for cheap or anything like that. Just get fair market value. And the other thing that I don't think we had kind of planned on talking, but I'll just bring up here, is also donating stays to a charity. So doing that is also considered a personal use day, right? It's a free stay. So we just also have to be careful about giving stays away, whether that's friends, a charity, or whatever. That's all personal use. So just need to be careful. If we can, just keep it simple. Rent the property, fair market value to strangers. Let your friends do the things that they're going to do or do something nice for them. Buy them a gift. Don't let them just stay at your property for free.
Yeah, absolutely. And there's two more things I want to tack on here because this is such a deep rooted thing that we have so many questions on this, right? So you have to remember, if you're staying at the property for repairs or maintenance and you're working somewhere like substantially full-time is how they define it in the regulations. And if you look at they don't really quite define how many hours is substantially full-time. But if you look at other areas of the tax code, it's usually somewhere between 4 to 6 hours. So if you're working on the property for 4 to 6 hours on repairs and maintenance, then that is not going to be considered a personal use day. So that could be a strategic way to plan how you spend some personal time at the property. And also within that, that's true even if other people are staying with you, right? So even if you brought your entire family to the property, as long as you're doing repairs and maintenance on a substantially full-time basis, then that day is not considered a personal use day, which can be quite impactful for a lot of people. That's just something you want to keep in mind there as well.
And that actually goes back to our first comments about the banking, right? So you could stay at whatever, at your vacation rental, short-term rental, get 14 days of essentially working on the property, for the property, doing the things like Tom said, repairs and improvements, and at the same time satisfy the bank who's saying you need to stay at this property for 14 days. Great. 14 days of repairs and improvements, right? That's essentially how that would work to satisfy both zero personal use, maximize tax savings, and satisfy the bank. Hey, yeah, but I was there for 14 days. They don't care if you're working or not, right? But the IRS does. So that's one way to kind of get the best of both worlds.
Yeah. One more thing. There's just so much that keeps coming up about this. If you try to swap your property, say me and Ryan, right? Say me and Ryan both bought Airbnbs. He had one in Minnesota. I had one in New York. And I said, hey, Ryan, why don't you come stay at my property in New York? I'll stay at your property in Minnesota and we'll swap days. Well, right in the regulations under 280A in the code, it says that if you do that, that's considered personal use. So there's all these things around personal use. Again, like Ryan said before, you don't want to get too cute. Just keep it simple, stay there for 14 days or less, and make sure you utilize the strategic use of repair and maintenance days to be able to get your personal time in. All right, because that's a big contention. I know people have beautiful Airbnb properties or short-term rentals, and it's just so tempting to stay there because they're so nice. But if you want to use this strategy, which I'm going to recap for you in just a second, then you have to keep that in mind. All right. And one thing I realized that we started off this podcast, we're so used to everybody knowing about the strategy. If you're new, you're just tuning in, you're like, what the hell is the short-term rental loophole to begin with? Well, long story short, all rental properties are passive by default. There's a bunch of exceptions. One of them is the STR loophole. If you have a property with an average stay of 7 days or less, or 30 days or less, and you provide substantial services to your guests, then it is no longer considered a rental property, it's considered a business. And if you meet one of the 7 material participation tests, we kind of discussed a little bit about that earlier in the episode, then your losses from your short-term rentals can be non-passive and offset your W-2 or active business income. And that's pretty much what the STR strategy is like in a nutshell. But as you know, there's so much more to it. That's why we're doing this episode today. But that brings us right into the next mistake. All right. The next mistake is having an average stay of greater than 7 days or 30 days if you provide substantial services to your guests. So you have to remember 7 days or less. That's 7.000000, right? If it's 7.01, done. And that's been proven by tax court cases. And we went through that in other episodes. And if you are providing substantial services, which are hotel-like services, daily cleaning, meals, things like that to your guests, if it's over 30 days, then you're not going to generally be able to meet this rule either. So just something to keep in mind. And I've seen this around, we'll get more into this, around people who are struggling to keep it under 7 days, right? You have to keep it under 7 days. So if you're looking for properties out there, STR properties, make sure it's a property you could rent for 7 days or less, because that's going to be critical in maintaining the strategy. Just to give a little bit more clarity on substantial services are, again, services that you'd find in a hotel, like daily cleaning, daily meals, perhaps concierge services, tours, things like that, dry cleaning, things. If you go to a hotel and basically you're providing services above and beyond keeping the property in normal maintenance, right? Like picture 7 days or less, that rule is like you're just renting out the property the same way you would rent out your standard long-term rental. Instead of doing it for, say, 12 months, you're doing it for 7 days or less.
Right. Yep. And I'll just say, practically, I have not seen a client who has actually gone to the level of substantial services. So I will just tell people listening, it is uncommon, it's rare to actually provide that substantial, again, unless we're talking about like a hotel or motel. So it is rare to see that, but we do want to make people aware of it, just in case we're trying to meet a specific strategy or trying to not meet a specific strategy. You've got some levers there, and we just want to have you have all the information you can in order to make the best situation and decisions for you.
Yeah, absolutely. I got one more thing to add in there, because I've gotten asked this question before and did research on it. So some people, sometimes when they have it stay above 7 days, right, perhaps maybe they're kind of in that midterm rental range, and we're going to get to the midterm rentals too. So just wait on that if you have questions about midterm rentals. But it's not enough to merely offer these services, right? Just because you offer, if say no one ever takes you up on them, you actually have to provide these services. And there's no hard and fast rule on it, but within the regulations where you could find the STR loophole, they're going to look at the frequency and the impact, overall impact of the property. So if you just do it one-off, you do daily cleaning once out of all your stays, there's a chance that might not be considered substantial services. It has to be ongoing and material, if you will. It can't just be something you're offering just to try to skirt the rules. There's something to keep in mind there, and that's in the regulations.
Yep, that's a good point. And the next one I'll hit on is the next big mistake that we see often. You want to be careful of is not documenting your position, right? The position obviously being that we are claiming the short-term rental strategy loophole. So 2 things I always mention as far as documenting this and protecting yourself under any sort of IRS audit. So number 1, because there's 2 steps, right? We got 2 things to document. Number 1 is calculate the average stay per guest that is less than 7. How do we do that, right? Go to Airbnb, download your reservations for the year. It will have a column that is going to show blah, 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 stayed here for these many nights. Do a little average at the bottom for the entire year and see, is that less than 7? If we're now pulling in, say you've got VRBO and Airbnb, that's on my short-term rental setup. I've got basically listings on both. Doing the same thing on VRBO and then just saying, okay, what's the total average between the two? That's it. It's that simple, but we just want to have that in place, ready to go to, 1, convince ourselves, yes, this makes sense. 2, tell our tax preparer or CPA, hey, this is what I got for the average. I think I'm good to go here. But 3, just in case of an audit or a letter or notice, you've got that ready to go somewhere in your files, or your CPA does too. The second thing is an actual time log. Okay, so your time log is for your material participation tests that you're going to meet. And so one thing to note, right? We get above the 500-hour test. That's one of the main 2 that we talk about. We really are just focused on our time. Okay, 500 hours. The second one is that 100 hours and more than anyone else test. Now, just a quick note there. We've talked about this on other episodes. If you're going to use that test, you need to not only document your time, but other people's time as well. You need to prove that you do have more time than anyone else. It's not just, hey, I got more than 100 hours. That is a common confusion or just kind of a miss that people have. So be careful. Make sure we've got a time log. And just to answer maybe a small question that might come up here, what actually should be on that time log? Okay. I would break it down just in simple terms so we can keep on with the podcast. 5 columns. Okay. Think of a spreadsheet. Number 1 is the date. Number 2 is the number of minutes or hours that you spent. Number 3 is the description. What did you do? Number 4 is who is doing that work. And number 5 is which property. Obviously, that's going to be more important if you've got more than one property. So showing a calculation of your average stay. And number 2 is a time log for material participation. Those are the 2 main things that we want to have in place at least.
Yeah, it's absolutely critical. Documentation. That's what's going to save you if you do ever get audited. That, and also calling a CPA to help you as soon as you open up the notice and send it to them in a timely manner. We talked about that on the STR audit episode. Don't wait till the last minute when you get audited. All right. Hey, are you tired of working with generalist CPAs that tell you can't use the real estate professional status, the short-term rental loophole, or cost segregation studies, or worse, have no idea what these things are? If so, it's time to elevate your game and work with a CPA firm that gets it. Here at Hall CPA, we worked with thousands of investors, helping them save millions of dollars in taxes through proactive tax strategy and planning, tax preparation, and outsourced accounting solutions. So if you're ready to elevate your game, make tax filing painless, and save thousands of dollars in taxes, what are you waiting for? Just head on over to www.therealestatecpa.com/podcast to request an initial consultation today. We are accepting clients for the 2023 and 2024 tax years, so if you're looking to make a change, you have nothing to lose. Again, you can request an initial consultation by visiting www.therealestatecpa.com/podcast. We look forward to hearing from you and learning more about your situation and how we can help. But for now, we'll dive right back into today's episode. Now, we're going to move right into, do short-term rental hours count towards reps? Now, this is a very interesting question, and Brandon and I went in depth on this on episode 239 of the podcast. So if you do want an in-depth look at this, I'd encourage you to go check that out. But long story short, there was 2 tax court cases. Both of them were named Bailey, 2 separate families, but very similar issues. It was just a coincidence. And basically, in those 2 cases, long story short, the tax court found that because the property had an average stay of 7 days or less, and it was not a rental activity, right? So in other words, they were using the STR loophole or whatever, they're eligible for it, that because it's not a rental activity, then it's not a real property trade or business, and therefore the hours do not count towards reps. And these tax court cases came out in 2001 and 2011, all right? However, in 2021, as part of the Tax Cuts and Jobs Act, one of the regulations under the business interest limitations, they updated the regulations under 1.469-9, which is where real property trade or business is found. And they updated the definition of real property trade or business. And they updated definitions of a few other things and gave a very clear example where that hotels and motels are indeed real property. That's A. And B, that there's an example about a hotel. And in that hotel, it was the primary reason for guests staying at the hotel was for the use of their real property, and all the amenities and all the additional services were just incidental to that stay, and therefore a hotel and a motel are real property trade or business. And so you're renting out your single family home or your condo, right, on an average basis of 7 days or less, then therefore your STR, your short-term rental, must also be real property. And I wrote an article on that got published in Thomson Reuters, Checkpoint, and there's a few other tax professionals who've been co-author with Robert Barnett. So shout out to Robert. But a few other tax professionals have also started to write about this as well. So my personal belief, okay, my personal opinion is with this new information. So I looked this up too, right? Regulations, new regulations. So these regulations came out in 2021. These tax court cases are from 2001 and 2011. The regulations supersede case law. Okay, that means that these are the new rules, and therefore short-term rentals should count towards your 750-hour reps requirement, but they will not count towards your material participation on your rental properties if you group them. All right, again, I know that might be a lot for everybody here. So again, episode 239, Brandon and I go in depth on this. So if you are interested in short-term rentals and reps, maybe you're trying to qualify for both, that's an episode you definitely want to go back and check out. But we're going to move right along here.
The next one is, are there limits on the amount of losses I can take if I use reps or the short-term rental strategy? The short answer is yes. I will just kind of preface by saying you're going to have a pretty sizable amount of losses to have it be limited. But what we're talking about is excess business loss limitations. These are a little bit newer and kind of the rules have continued to change and whatnot. But essentially, I'll just kind of break it down this way. So the excess business loss limitations for 2024 is $305,000 if you're single and $610 if you're married filing joint. Okay. So let's say, for example, you've got $700,000 of W-2 wages and you've got $600,000 of losses from your short-term rental. Okay. In that situation, married filing joint 2024, no issue. Okay. We haven't had losses that exceed that $610,000 limitation. So we're all good. We can use all $600,000 of losses from the short-term rental to offset that $700,000 of W-2 wages. No problem. We're then only paying $100,000 of income. Okay. Changing up the situation to actually have the limitations impact us. Let's say we have $700,000 still of W-2 wages, but this time, let's say we have $650,000 of short-term rental losses that, again, they're non-passive. Okay. So now we can only take up to, in 2024, 610 of that 650. Okay, so that spread there of 40,000 is going to be carried forward to 2025 as a net operating loss, or NOL. Okay, it's still, I just want to comment, it still contains the non-passive character. It doesn't all of a sudden become passive the next year. It holds the characteristic of being considered non-passive. But now we've got all these losses we have to carry forward. Unfortunate, but we were still able to take the whole 610 and offset against the 700. Now we're paying only income tax on the $90,000 that's remaining. So there is a limitation there. We do need to be careful. Be just well informed that it's there, but we don't lose the losses. It's just a timing thing of when you get to use it next year.
Yeah, something interesting, as bonus depreciation kind of phases down, we see this a lot less being a problem. But it was more of a problem. Well, actually, quick history, this W-2 wages were actually considered business income, believe it or not, up until the CARES Act in 2020 clarified that. So it's just very interesting. But yeah, as bonus depreciation kind of phases down, we see this being less and less of a concern for people because you're not just getting these huge losses like perhaps you may have been in the past. So just something to keep in mind. But now we're going to move on to midterm rentals, okay? So first thing I want to say, as far as the tax code concerned, there's no such thing as a midterm rental. You have long-term rentals and you have short-term rentals, right? Or rentals that meet the exception to the definition of rental activities, but we know them as short-term rentals. Again, a short-term rental, average stay of 7 days or less, or 30 days or less if you provide those substantial hotel-like services, all right? Now, what ends up happening is there's certain locations or certain places where you might have a lot of traveling nurses or traveling doctors or digital nomads, what have you. They may want to stay at the property for perhaps longer than 7 days or perhaps even 30 to 90 days, right? And we have to remember this 7 days or less stay is calculated on a yearly basis based on all of the stays on that property, not just any one, okay? So if you're renting the property for greater than 7 days and you're not providing these substantial services, then it's going to be considered a long-term rental for all intents and purposes, meaning that if you have a midterm rental, you have a long-term rental, and the way to make those losses non-passive is going to be the real estate professional status, which is outside of the scope of this episode, but we have an entire series on reps 01, 02, 03, so on and so forth. You go back and check those out if you do want to know more about reps. But long story short, a midterm rental is a long-term rental for all intents and purposes here when it comes to taxes. All right. And I think that's where we're going to get into a very interesting question. The next question, it kind of segues right into the next question.
Yep. So the next one is kind of talking about if we have the same guest staying at the property multiple times and trying to use the short-term rental. And so really the crux of the question comes down to, how does someone staying there multiple times impact my average stay per guest? And we have talked about this again on another episode, I think with Justin Shore, kind of diving deeper into this. But at the end of the day, we just need to be very careful of the same person using the property multiple times in the same year. And I think the key words here, Tom, just correct me if I'm wrong, is that they have regular and continuous ability to basically stay at the property, right? So if they basically are able to have blocked off access like in the future, it's almost seen as though that's like one continuous stay that's going on instead of like all these miniature stays that keep the average stay below 7. So we just need to be careful of that. Again, this just comes back to big picture. Don't try to be cute, smart, try to, game the system in any way. This is talked about in other areas, and we just don't want people to try to, again, be careful here, because this can come back to bite you if you think you're getting smarter by simply having and showing all these stays. What they're going to do on the IRS audit side is probably just pull up that average stay calculation and then see that you have all the same person staying at your property multiple times throughout the year. And that's likely going to be some questions about how regular or continuous or kind of blocked off did this person have access to stay at your property. And one thing to note too, I believe it doesn't actually matter if they stay. It's kind of a matter of,
Right.
do they have access or the ability to stay there if they want to? So just be aware, people listening, you just don't want to be doing things like this just to try to keep your average stay below 7. Put it on the market, let various people stay, show it as a short-term rental that way.
Yeah, absolutely. Long story short, can't use back-to-back leases. And like Ryan said, if they have the right to use the property, it's considered a stay. So for example, if I were to stay for 7 days in Vegas and 3 of those days I hop in the car, I drive to LA and I'm gone for 3 days, because I have access or the right to use that property for those 3 days, just because I'm absent from the property, it's still considered a stay because I had access and the right to stay at that property, even though I did not physically stay there during that time.
Yep.
The next biggest question we get is what happens in year 2? Okay. So as we know, when we use the STR loophole, we're usually going to use cost segregation and bonus depreciation to jack up that loss in that first year. And that all comes in the first year. Now, what happens in year 2, you're still going to have some depreciation benefit from depreciating the property, which is done over 39 years, okay, for in most cases for short-term rentals. And so you're still going to get a little bit of that depreciation benefit, but it's usually not going to be substantial. And if you're playing the short-term rental game the right way, you might even have income, okay, in that year. So just something to keep in mind. In year 2, you're not going to usually have this big jump in losses again, unless you're actually probably losing money or you're mismanaging your property, right? So that's what happens in year the big benefit comes in year 1 and then in year 2. And I think that kind of brings us into another question. These all just kind of segue right into it.
Before I move on to the next one, I do just want to say I've talked to a couple people in the last 12 months that were actually surprised that they could again in year 2 meet the short-term rental strategy, because they are just kind of focused on the first year. They're like, hey, I'm done, right? I do the cost seg, I get these massive losses. Hey, I'm done. Year 2, I can't do anything. It's just automatically going to be passive. Not true. It ultimately comes down to, like Tom said, okay, if you're maybe poorly managing it or you've just got less revenue than you expected, maybe you're showing a true loss. Sure, it might not be that substantial, but just know the material participation, that evaluation and the average stay, that is a year-to-year consideration. So, for example, I've had 2 people I can think of off the top of my head where they actually in year 2 still expected kind of a pretty substantial loss because 1, they weren't actually performing that well, but 2, they had actually dumped some of that money back into the property, made some additional improvements, some new furniture, some new landscaping, things like that. Now they've boosted all these additional expenses, not from depreciation necessarily, but literally just from repairs and improvements. So then second year, they've got this additional 20, 25 grand of losses. Hey, if you're at the 37% bracket, that could be an additional $10,000 or whatever it comes to in tax savings. So let's take advantage of that. Yes, it's beneficial for you to still document your time and keep that average stay there. So yes, year 2, it's usually not going to be this sweet amount of depreciation, a huge loss. But year 2, depending on how profitable you are, you could actually have a loss in the second year. So that does lead perfectly, like you said, Tom, into this next one. And that is, can I make my short-term rental an LTR, a long-term rental, the next year, or a primary residence or passive? So the first thing I just want to say is we want to be careful of changing a property's use, nature, whatever, from a short-term rental 1 year to then all of a sudden be used differently in the second year. Okay. So first year, let's pretend we've got the average stay, short-term rental loophole, great. But then the next year, you actually have an average stay that's, call it more like 10 or above. Okay. So meaning we definitely can't meet the short-term rental strategy. The risk there, to me, is that the IRS may come back after looking at the facts and circumstances and maybe your intent, basically conclude that all along you only use the short-term rental strategy, that average stay less than 7 material participation, only for tax purposes, and it was never your intent to continue to use the property like that moving forward. So there's just some risk that they effectively walk back your ability to use those losses. They basically take them back. Now, if they're auditing you years in the future, here's your additional interest, here's your additional penalties, and so forth. And we just want to be really careful. And the only way that I've talked with clients, and Tom, chime in too here in a bit, but as I think about, some of my clients are like, well, what if they basically take away the short-term rental use that I can do based on my county or city because if there's some sort of ban, right? Short-term rental ban, and I just can't keep the average stay less than 7. Okay, that's a completely different situation, right? That's out of your control. That makes sense of why it would change. However, if there's no other significant business reason for why you're changing this to now be a midterm rental or a long-term rental, there could be some risk of kind of showing what your true intent was. So I've had other clients say, okay, there's not a ban, but actually, Ryan, it's more efficient, more profitable if I do turn this into a midterm rental. What if I do that? Again, there's still the same risk. However, if you are actually showing that you can get more revenue or more profit, you're at least showing that there's a business intent, a higher profit motive for why you're changing the use. And that could at least give you a better outcome, a better chance of not having them take away in that first year the short-term rental strategy. So a lot more to say here. I'll try to keep it short. Tom, what comments do you have?
Yeah, I think the biggest risk that people run into with this is, especially when buying it around year end, right? Like if you buy it around year end, you rent it out for only a short period of time, maybe just a week or two in December or November, and then you flip it into a different type of property the following year, very shortly into it. I think that's where this risk originally came from, right? That's where we kind of realized, like, okay, this is a little hairy here. But if you have like Ryan was saying, if you have a legitimate business purpose for doing so, then you have a much stronger case against, that the IRS is viewing it as, you were using it as a tax shelter only, right? That's the big thing we're trying to avoid here is using it as a tax shelter.
Yep. And the other thing I'll just comment too, because another super common question, and we can get to the next one, is what if it's passive the second year? Passive the second year is a little bit different, right? Because we're not changing the use necessarily, right? Especially if we're keeping it an average stay less than 7, that's good. But if we simply are changing, can we meet material participation? The passive, non-passive thing is an issue to consider, but second year, remember, it's more of the default that real estate will be passive. So it's almost not a surprise that would happen the second year. And it's also not a surprise that the first year, you're getting everything set up, all the furniture you're going to buy, all the advertising, all those things getting set up. It's not uncommon to see it non-passive in the first year. So I want people to just hear the issue is more the average stay being changed. It's not so much the material participation step 2 being the issue.
Yeah, no, that makes a lot of sense. It's when you're starting up a business, a lot of work that goes into it. By year 2, you could have the whole entire thing systematized down to a nice, neat package, and it's just passive because there's just not much for you to do, right? That could certainly happen. But that brings us to another question. Will the STR loophole be quote unquote closed? So we've discussed this here on the show before. Some people consider the STR loophole a loophole because it allows you to take your standard condo or your standard single family rental and turn it non-passive, when really the intent of Congress was to prohibit that from happening with the passive activity rules that came out under the Tax Reform Act of 1986, as well as the real estate professional status, 750 hours, more than half your total working time. That's why some people consider it a loophole. But it's really not a loophole. These rules have been, a technical loophole. These rules have been in the tax code for decades, And this is just the way it works. So we've seen nothing. Literally, I've seen nothing to indicate that this will be closed. However, I do think that this is being taken care of by the free market, if you will, where states and localities such as New York, LA, and plenty of others are putting restrictions on how many short-term rentals they'll allow in their city, how long you can rent out your property for, and it's becoming a lot more tighter. And we went through this on an episode with Ron Rohde. I forgot what episode it was, but that might have actually been for the Tax Smart Insiders group. So if you're not a Tax Smart Insider, go check that out there. But basically, we don't see it being closed at the federal level in the regulations or the tax code itself. Really, what's going to happen is over time between the market competition, so saturation of short-term rentals in the market, and the state and local governments self-regulating what they allow, and the condo associations also regulating it, what you're allowed to do, that's kind of taking care of itself. But I don't see it being eliminated. I've not seen anything to indicate that that's going to be the case.
Yep, I would agree. And I think I just saw a headline today or yesterday that said Barcelona was getting rid of the Airbnbs as well. They were doing a ban. I know we're talking about a different country, but at the end of the day, it's just becoming more common for especially urban areas to want to get rid of these, or at least a limit. Some of them, it is like an elimination strategy, I think is kind of what they're going for. But some of them is just kind of putting a cap on it. So yeah, that's going to continue to come out kind of at the state, local areas, but probably not at a federal tax change that we would foresee.
Yeah, no, absolutely. Absolutely.
The next one is, can you use the short-term rental loophole in California? And this question, I think, commonly comes up because people know, especially being in California, that you cannot use real estate professional status. So the question then becomes, can I use then the short-term rental strategy, right? They do a similar thing. If California at the state level doesn't allow reps, real estate professional status, can I use the short-term rental strategy? As far as we are aware at this moment, the answer is yes, that you can use that. There's nothing that we're aware of that they have banned that necessarily, but it does come back to, okay, does your local, county, whatever, ban short-term rentals or put a cap on the number of short-term rentals and whatnot? That's more of a factor, but we think at the state income tax level, we are not aware that they have banned that. Some might extrapolate that there is more risk that they would ban that more explicitly because they've banned or, explicitly got rid of reps for long-term rentals, that they might just in the near future say, hey, you can't do short-term rental strategy either. So be aware of that. That's always a potential out there, but nothing that I'm aware of that would say otherwise. Is that right for you, Tom?
Yeah, that's the way I understand it as well.
Yeah, awesome.
And then as for foreign countries, can you use it in foreign countries? Long story short, you can. However, the issue with doing that is when you have a property in a foreign country, you have to depreciate over the ADS system, which means that you're not able to use bonus depreciation, which kind of nerfs the entire power of the strategy. If you're not able to do that, then sure, you might have some minor losses perhaps, but it's not going to be substantial. So while theoretically you can use it, it's just not going to be as impactful, really making it almost really ineffective while you're doing it in foreign countries. And then we have the last few questions here on bonus depreciation. What property is eligible for bonus depreciation? Long story short, if you purchased the property after September 27th, 2017, your property is eligible for bonus depreciation. And depending on what year you place in service will determine the amount that you're eligible for bonus depreciation. Really not too much to discuss here. We kind of beat bonus depreciation to death, I'm sure. These are common questions we get. Last but not least, will bonus depreciation be extended? Who knows at this point? I'm optimistic that it will be. And this is my opinion. I think that if they made permanent 50% bonus depreciation, that would be, barring any type of, financial fiscal things that they need to manage and monetary things, because tax policy sometimes is used to manage the macro economy, and, how much depreciation people get can impact the amount of free income they have, disposable income, things like that. I would like to see 50%. I think that's a fair number if they did it just permanently 50%.
Yeah.
That's my opinion.
Yeah. And I know we've talked about, this bill getting passed through. I don't think it's going to have any impact on 2023's tax year. I think we're well into 2024. That no way that it's going to have an impact on 2023's tax year, which we had 80%. Is it going to impact 2024, right? Might they have something get passed before we have the presidential election, or might something get passed after we have the presidential election? And there might be some tax law changes. Politicians, presidents, and whatnot like to do that. So I think it's a potential still for 2024 to be changed, right? We're currently at 60%, but not 2023. 2022, obviously, we got 100%. I think 50% would be great. I think even better would be 100%. So
Right,
we're all
right,
rooting
right.
for 100%. I know you are too.
Yeah, no, no, no.
um,
I'm all on board if it was 100%. I'm just trying to come to some middle ground, if you will, realizing that like 100% bonus depreciation. Now we're getting into some speculation here, but I think this is more than speculation. I think part of the reason why you've seen the demand not only for short-term rentals, but the demand for long-term rentals since 2017 has partially been driven by the power of bonus depreciation. When you combine that with reps or you combine that with the STR loophole, that's driven demand for this asset class. And that's problematic, right? In terms of marketplace dynamics, people are buying the properties sometimes for the wrong reasons. We talk about don't let the tax tail wag the dog, but the reality is plenty of people out there, rightly or wrongly, are letting the tax tail wag the dog, and they're jumping into an asset class, inflating prices. I'm sure it's contributed to inflation of real estate and investor appetite for real estate. So there's other considerations besides just tax when it comes into bonus depreciation. And that's why I'm just saying 50% still gives the people who are in the game the ability to accelerate and benefit from it, but perhaps it isn't as enticing for, your average Joe's. Like it's just not as mouth watering as maybe it is. And that's just kind of my 2 cents on it. But yeah, I would love 100% bonus depreciation just as much as anybody would. I'm just thinking is it practical to actually do that? And I don't know that it is. It might be.
Yeah. Yep.
All right. So I think that's it for today's episode. I think we're spending close to probably 40 to 50 minutes on STR questions, just to let you know how in depth this goes. I'm going to have a special offer for you on our short-term rental course, which breaks down everything you need to know about the short-term rental loophole to save up to 5 to 6 figures in taxes. So stick around for that in just a second. But as always, if you are looking for a new CPA, perhaps your CPA doesn't understand these strategies, or perhaps they don't understand real estate in general, and you're just looking for experts, we are always taking on clients. You could learn more and request an initial consultation at www.therealestatecpa.com/podcast. And also, if you are looking for a new opportunity, looking for a new job, maybe you're CPA or EA, we're always looking for the best talent out there. So if you're interested in joining a team that's on the cutting edge and you love talking about real estate tax, you could go ahead and send us an email at onboarding@hallcpallc.com with your resume, your desired position, and a little bit about why you'd want to work for our firm. We look forward to reviewing that, hopefully meeting you at some point in the future. But again, stick around just 1 second. I have a special offer for you on the STR Tax Course. Hey, are you an investor looking to slash your tax bill? Then get ready to discover everything you need to know about the short-term rental loophole to save up to 5 to 6 figures in taxes with our comprehensive STR Tax Course. Valued at $247 is now just $1 for a limited time when you sign up for our Tax Smart Insiders community. Here's what you'll get when you sign up. Learn tested methods that have helped thousands of investors maximize their tax savings, get expert guidance and support from our team of real estate CPAs, and enjoy unlimited access to the course materials. Don't miss out on this incredible limited time offer. Visit www.taxsmartinvestors.com/free STR course to enroll today. Again, that's www.taxsmartinvestors.com/free STR course to enroll today. And we'll see you next week on the next week's episode of the Tax Smart REI podcast.